morning, Twin Cities. Welcome to your Sunday and welcome to Reckoning with Real Estate, a show about the American dream and building a better real estate company. I'm Paige Kao with the Real Estate Collaborative, and I'm joined today with Matt Berna with Truestone Home Mortgage, an equal opportunity lender. And he is also one of our sponsors. So welcome, Matt.
Hi, Paige. Thanks for having me. How are you?
Yeah, well, as we talked about, I'm tired and my back hurts, but other than that, I'm great. How are you?
I'm doing good.
Good.
I'm doing really well. We're both a little tired. It's been a long week with the holidays. We gotten some snow, but
Yeah.
nice to get back in a groove, and hopefully your back feels a bit better soon.
Yeah, agreed. It will. It'll work itself out. So Matt introduced himself. I think it was on episode 3. I was listening to some of our past episodes. But do you want to just do a quick introduction for those of our listeners who are just joining us?
Yeah, sure. Definitely. That's a great idea. My name is Matt Berna. I'm a mortgage loan officer for Truestone Financial Credit Union. We are an equal housing opportunity lender. Very grateful to have the opportunity to partner with Paige and help out our mutual clients. I'm here for any sort of questions that comes through about the mortgage process. If you're a first-time buyer, a repeat buyer, move-up buyer, maybe thinking of downsizing, selling, anything that comes up with the mortgage financing world, I'm here and available to answer questions, bounce ideas off, give feedback, and just assist in any way I can.
Yeah, great. And we have enjoyed working with you for, I guess, about the past 3 years.
It's crazy. Goes by quick.
It does go by quick. Today, we're going to talk about a couple of the things that have been in the news recently in the past few weeks that have been floated by, I think, the current administration. We're going to talk a little bit about refinancing. We're going to talk about 2026, and if you're thinking of buying or making a move, kind of what to do to prepare now, since some of us are going to have some time off in the next couple of weeks. And we'll also talk about maybe how to pay down your mortgage a little faster than the 30-year amortization. So
that's nice, right?
Yeah, it's I think it's, I mean, it seems to me it's easier to do than most people think.
Yeah.
So why don't we start, though, with the 2 ideas that have been floated recently. The portable mortgage, which I will say I'm not super familiar with that idea. And then the 50-year mortgage, which I have some thoughts about. But let's start with the portable mortgage. And why don't you explain what that is and what that means?
It was funny. It seemed like there wasn't a ton of topics coming about mortgages, and then all of a sudden it's like, hey, let's throw a dart at a board. Let's pick a couple of random things to say and release. Everyone's like, what is going on? Where did this come from?
That's kind of what it felt like to me too.
I do think that in general, having ideas about mortgages is good when we think about the total affordability of a home, right? There's an affordability crisis. Things need to happen. So even though if these ideas aren't the greatest ones or the ideal ones, at least the conversation is starting about the affordable crisis.
I totally agree with that. So, yes.
Silver lining, right? We're getting something. Assumable mortgage. Portable mortgage. I had not heard a ton about this before, so I had to do a little bit of research about them because it sounds kind of goofy. What is a portable mortgage? You kind of pick it up and take it with you.
I know, it sounds like you're putting it in a suitcase and walking to the new house or something. Yeah.
But that's kind of what it is.
Yeah.
So I looked, it's actually pretty common in Canada, in the UK, Australia, and there's a couple other places. So it got introduced in the 80s, and it basically works just like how you described it, right? You have this mortgage that's tied to you. If you buy a new house, your mortgage goes with you to that new house.
Okay.
Apparently in these other countries where they're more popular and commonly, not want to say commonly used, but actually as a viable product, the mortgage there doesn't have like a payoff feature like it does for us. Like for us, you pay that mortgage off when you go somewhere new. I believe in those other homes, those other countries, they don't have that. So that's how you're able to carry that with you. It's like a financing instrument that's carried to the person, not so much specifically to the house.
So can I ask a follow-up question?
Yeah.
With that? How does that work? Because I know in our country, the mortgage is tied to the house and not to the person, and the house is used as collateral. So is the person the collateral?
I don't know. I'm not
Yeah.
sure, but I know that's why it would not work for us, is
Okay.
because if someone's leaving that house, that mortgage should be paid off. They can't take that mortgage with them to a new home.
Right.
It wouldn't work in America. I think it was just like a spitball idea to get headlines, which it seems like is a common a common thing they like to do.
Yeah.
So
Yeah.
it's not a viable option for us. I don't think that would work in our current mortgage marketplace, our current housing marketplace. Um, it sounds interesting though, right? Like, hey, if someone has this lower rate, they want to carry it with them. But I don't know
Right.
the dynamics of how that work if you're moving up to a higher purchase price, or what do you need to borrow more on that specific rate? Can it increase?
Right.
So who knows? I don't think it's anything's going to come from it. I think it's more of just a spitball idea to put something out there and generate some buzz.
And it must have been, I know in the housing market, there are a lot of people that are very attached to their low interest rates that they got during COVID, that 2-3%
Yep.
interest rates. I know we talk to people all the time that, maybe they want to make a move, but they're like, we have this, great interest rate.
Yeah.
And for the people that need to make a move, like for their growing family or to downsize, people are willing to give up that lower interest rate, but people get it impacts payments
It does.
immensely to have that lower interest rate, which is a good segue into the 50-year mortgage and what that is all about and how that affects payments.
I mean, if you think 30 years is long, who cares? Let's go on for 50, all right? It's right around the corner. It's funny at closing when we print off the amortization schedule and it's like 11 pages of payments. Like, yeah, just come on, just double that for 50 years.
Yeah.
Picture that line item of 600 payments for someone.
Right. And I'm in closings all the time where the title person is going through that and showing them the amortization schedule and the buyer's eyes just bulge out like, wow.
Yeah. Print that off, put it in your fridge, cross the line off each month. It'll be there for a while.
Yeah. And so for the listeners that aren't familiar with amortization, I mean, what that does is when you get a mortgage to buy a home, it creates equal payments throughout the 30 years for the principal and interest. Now, taxes and insurance will go up year over year generally, but the principal and interest, that payment is going to stay the same every month.
Yep.
Right?
As long as you're in a fixed loan, correct? Fixed rate loan.
A fixed rate loan. And then the interest is really front loaded.
Correct.
Will
Yeah.
you explain what that means?
So if you think about it, I think it's called an inverse, right? Inverse scale. It's, one, the interest starts up a lot higher for where your beginning payments are and your principal's lower, and it builds over time and they get inverse. So eventually you're making more payments towards your principal than your interest. But in the beginning, it is very, very heavy interest payments.
So if your principal and interest payment is, let's say, $1,000, which is very low, but let's just use that because it's easy math. Your interest for the first
couple of years is probably $900.
And then the principal amount you're paying off is $100. And it varies.
Slowly changes over time, right? Because each month you're making a principal payment. So it's paying down that principal balance. So your interest on it goes down and the principal payment goes up. But it just takes some time. It's very, very top heavy in the beginning with interest.
Yep.
So when you think about that over 30 years, right, you stretch that over 360 payments.
Yeah.
So you think of a couple years that you have that are a lot of interest. But if you expand that even further to a 50-year,
right.
I mean, I wrote a couple numbers down just to talk about. And this idea, I think, has already been thrown out as people were immediately like, this is terrible. What is going on? Not a viable option. I will say it could bring payments down for some people, right? Because you're stretching that term out. So it does bring payments down, but you think about the total cost of that loan, what you're paying on interest, it's mind blowing the difference between the two. So I got a couple numbers here for you.
Great.
When you think about terms, right? A 10-year, a 15, 20, 30-year, the lower the term, the lower the rate normally. So in that same thinking, if you do a 50-year, it's a longer term, it should be a higher rate than a 30-year as well.
Oh, sure. I hadn't thought about that, but right.
Yep.
Yeah,
there's
that
more
makes
exposure.
sense.
They're stretching it out longer. It's going to be a higher interest rate. So for this, I used a 6.5 just as a guess for a 30-year, probably a 6.75 for a 50-year. Your payment, principal and interest, it does save a little bit. So on the 50 year, you're at $1,973. 30 years, $2,212. So it is $239 less per month, which sounds nice, right?
Yep.
The big difference where the numbers really skewed the other way is you look at the total life of this loan. So on a 30-year mortgage at 6.5, you'll be paying $446,000 roughly in interest total of the life of the loan. If you didn't make any extra payments, you paid that out the entire 30
And that's
years.
just the interest. That doesn't include the principal. That's like, what value home were you
That was
using?
a $350,000 loan.
$350,000.
So yep, you're already paying more in interest than you would that the total loan was.
Okay, so
on a
say
30.
that interest number again on $350,000.
Yep, $350,000 loan at 6.5% on a 30-year mortgage would be $446,000 roughly.
Yeah.
Change. Entire life of the loan paid for interest.
If it was fully amortized over the 30
Correct.
years.
Yep.
Okay,
Yes.
got it.
The difference for a 50-year, so that 50-year, same loan amount, $350,000 at 6.75, $873,000. So it almost doubles of what you're paying total interest on that life of the loan.
Wow. So what you're saying is, let me get this straight. The 50-year mortgage would be great for the banks and the lenders.
Yeah.
And kind of okay for the buyer if you're looking for kind of a lower payment.
Yeah.
But really over the life of the loan, not such a great deal
And
at all.
I think another spot where this really shows is the equity that you build. So, right, we talked about how those payments work. At the beginning, it's so heavy in interest. In 5 years, on the 30-year scenario we talked about, you would have probably $23,000 in equity just based off your payments, right? So it's not assuming any appreciation.
5 years, okay.
5 years, $23,000 in equity versus your payments. What do you think it is for the 50-year in 5 years?
So you said it was $23,000 roughly for the 5 years of the 30-year.
Yep.
Sorry, this is a lot of numbers that we're throwing out at you, but we'll have something in the program notes that breaks this down too. I'm going to say, I don't know, based on the way you asked the question, $7,000.
$5,000 in equity.
Wow,
that's based really just off, it's not any appreciation. That's just your payments. $5,000 after paying on that for 5 years. That's all you have in equity based off the principal amount, which is nuts. That's crazy.
It is. And then people would need to stay in their homes much longer in order to, fully get to a point where they could sell them and maybe without any appreciation. And of course, we're still seeing drastic appreciation in our market. But well, those are great numbers. And like I said, we'll put some of that information in the program notes for those of you that want to kind of look at them and see them in black and white. I know sometimes it's hard when we're talking about the numbers, but I think it is time to go to break. And you are listening to Reckoning with Real Estate, a show about the American dream and building a better real estate company. And if you'd like to find us online, you can go to therecolab.com. That's THERE as in real estate. Colab is short for collaborative. Therecolab.com. And we will be back in a few minutes. Take my breath away. Oh, wrecking ball, you still. Welcome back to Reckoning with Real Estate, a show about the American dream and building a better real estate company. I wanted to mention you can find us on all the podcast platforms as well as YouTube. Just search for Reckoning with Real Estate and you will find us. And with that, I'm in the studio with Matt Berna, one of our sponsors. He's with Truestone Home Mortgage. And Matt, why don't we start the second segment with where can people find you if they would like more information?
Of course, yeah. All of my information, Matt Berna, loan officer at Truestone Mortgage, equal housing opportunity lender, is listed on our program. It's in the bio for our show. You could go to Truestone's website, and I am on there as well under the home mortgage section. Call, email, text. If you want a fax, I think I have a fax number on there. Any way you want to find me is more than fine, but I'm available on social media, online. All of our information is listed in the program's description. So, yeah, please reach out. Here to help.
Yep. Yep. Great. So we kind of put the portable mortgage and the 50-year mortgage to bed during the first segment. And we are going to talk for the next few minutes about refinancing and what that looks like as we're headed into the new year for people who might be considering that.
Yeah. So, I mean, we've actually seen rates come down pretty decent this year as well. So I would say if anyone's interested in what mortgage rates look like, TrueStone has a tool on our website you can look at. Otherwise, a good resource that I use is Mortgage News Daily. They have a website, they have an app where it'll show a breakdown of national trends of where rates are. So a lot of the rates that I reference on this show, I'm always going to be using the Mortgage News Daily just as a baseline of what things look like. But yeah, if you purchased in the last couple of years, you might have an opportunity to refinance. You think about where that rate was when you bought, the appreciation you've had in that home over a couple of years, the payments that you've made. And I know we talked about how that payment schedule looks, and not a lot goes towards principal in the beginning. But if you have a chance to refinance, bring your rate down, that's a nice way of allocating more towards principal because there's less interest that you're borrowing on it.
Yeah. Do you have an example in the past couple of months of somebody that you've helped refinance and how much it saved them? I'm putting you on the spot right now, I realize.
Yeah, I actually am doing a refinance for someone right now who bought in March of this year.
Okay.
Her rate when she bought was 7.375%.
So she just bought this year and she's refinancing.
Correct.
Okay.
Yes.
And what was her rate?
7.375.
Okay.
And now she is going to be at 6.125%. Granted, there's other costs that's not an APR. There's things that go into mortgage rates. So disclaimer, when you think about interest rates, you'd have to look at your points being paid with it. There's so many different things that go into it, your credit score, the down payment, the property type. So each scenario is specific to an individual person. So I just say, to get an actual rate quote from someone, reach out to a lender, reach out to myself to give you an idea. But this is an instance where someone who bought 8 months ago,
Right.
7 months ago, and she's an opportunity to refinance and save a couple $100 on her mortgage payment and save 1.25% on her rate.
And what do you remember what's the value of her home or her condo? Or
she put 10% down.
10%
on
down.
her purchase. Yep.
And what's the is it like a $300,000 home, $400,000 home?
It was a $320,000 house condo with 10% down.
Okay. And I'm assuming with refinancing, there are closing costs that people have to pay at closing?
Correct. Yep. So you do have closing costs on a refinance as well. There's lender fees, there's title fees. You have to re-record that mortgage with the county as well. We have seen a couple of changes with title fees though. So title insurance used to be redone each time there was a new mortgage recorded on that property, but I believe that's changed now. So there's no more owner's policy. They use the existing policy. So that saves a little bit on the title fees. But then whatever lender you're using, they might have their own specific fees. And another piece I think a lot of people don't think about is if you escrow for your taxes and insurance, a lot of times you have to set up a new escrow account on that new loan.
Oh.
If you're refinancing with the same lender, they might have different options if they can net the escrow accounts. But most common option, let's say you bought with one company and you're refinancing with another, they're going to mail you a check for your escrow account, which has been, how much you've saved for your homeowner's insurance and your property taxes. On this new loan, if you're going to do an escrow account again, they have to reestablish and a new escrow account. Establish a new escrow account.
Even though you're not changing your insurance company or anything, but you're saying it's a different lender, so they're going to have their own escrow account that needs to be set up.
So you as a buyer, you're going to get refunded that from your original company, but you're going to have to start a new escrow account with the current lender. So I think sometimes people see this number like, oh my gosh, my closing costs, but that's where it helps to have a good lender to walk things through. Okay, well, we're establishing your new escrow account. We know your first half property taxes for Minnesota are due in May. We need to collect enough to have that first payment plus the buffer for your escrow account. And then depending on whenever your insurance renewal is due, dictates how many months of insurance you have to collect as well.
So for listeners who may not be familiar with escrow accounts as they relate to a mortgage, what is the escrow account?
I like to think of an escrow account as a savings account for your house, right? So if you do escrow for your taxes and your insurance, each month you're making a payment of 1/12 of your annual property taxes and 1/12 of your annual homeowner's insurance. It's right along your payment. It goes into the savings account for your house. Then when it's due, the servicer makes those payments on your behalf. So
Yeah.
it's kind of like you're paying all year to do it, and then it gets paid when it's due by the servicer.
So your total monthly mortgage payment is the principal and interest, and then the taxes and insurance for that escrow account. I call it PITI.
Yep.
Principal
PITI.
PITI. And some people who maybe put 20% down or more can be responsible for their own paying their own taxes and insurance outside of their mortgage payment, correct? Is that still true?
Correct. Yep. It's dependent on what that servicer is and who that servicer is and what they allow. But for
Okay.
TrueStone, for us as a servicer, you have to do at least 20% down, and then you could decide if you want to escrow for tax and insurance or not.
Okay.
And you could do, vice versa. You could escrow for just insurance or just taxes,
Sure.
both, neither, one. But it needs to be at least 20% equity in the house or 20% down.
Yeah, and I think some people, even if they're putting that much down, they're just like, you do it. Let the lender handle it, because it's kind of a no-brainer. You don't even have to think about it then.
Yeah, I would say if it's your first house, it's easier to do an escrow. If you've bought homes before, you're used to doing that on your own, then maybe it makes sense. I think people look at it like, that's my money I could do something with throughout the year versus having it sit in an account.
Okay, cool. So one thing we were talking about before we started the show too is how folks can pay off their mortgage faster than the 30 years.
Yep.
That I'm just going to assume most people have a 30-year mortgage. What are some tips that you can give folks if they want to try to pay their mortgage down sooner?
Yeah. So I'll give you one tip, and then one thing I see that I think is a misconception that's out there.
Yeah, great.
So a rule of thumb is if you make one extra payment per year, that would take 7 years off your total life of the loan.
Wow. And does that one extra payment all go to the principal then?
Correct. Yep.
Okay.
You'd want to allocate that towards your extra principal amount. So I talk to people about it. I always bring this up when I'm at closings. And it's either, hey, you could figure out whatever your monthly payment is, divide that by 12 and do an additional amount each month, right? Your principal. Or some people are like, hey, I like to do it quarterly. You can figure out that way, or maybe just one lump sum payment.
Yep.
As long as you do that right towards your principal amount, that's going to lower the life of the loan by 7 years.
So you have to specify, I want this $2,200 payment or whatever to go towards the principal. You have to spell that out with the lender.
Yep. Wherever your servicer is,
Yeah.
or whoever your servicer is, the platform where you make your payments, it should have options in there, right? You make your normal payment, anything additional, what do you want it to go to? So you just always say, I want that to go towards my principal amount.
That's in 7 years.
Yep.
Shaves off 7 years of the 30-year mortgage. That's great.
It is. Yep. And you think about how much more equity that builds you quicker, right? Because you're paying that principal amount down each month. And that misconception we talked about. So I've seen like TikTok videos, Instagram reels about, if you make your payment in two bi-monthly payments, that you're actually making extra payments each month or extra payments each year, and it pays down your principal. Most servicers aren't going to apply a payment until the payment is made in full, right? So you can't just say, hey, my payment's $2,000. Here's $1,000 now. I'll pay $1,000 in 2 weeks. Most servicers are going to hold that $1,000 until the payment is full. So then there's $2,000 and they make the payment then. So it's not like you're actually getting a leg up. It's just going to be holding it until the full mortgage payment is due.
Okay.
Or made.
So really the way to do it is to figure out if you want to do it quarterly or so pay every month, whatever you're supposed to pay. And then if you want to try
on top of that, do some principal payments. Yep, exactly.
Yeah.
Anything you can do towards your principal just is going to set you up so much better in the long run because it pays down what you're borrowing for the entire life of the loan. It builds your equity faster, just puts you in a better spot overall.
Okay. Well, that is good to know. And then since we're headed into a new year, 2026, if somebody is thinking of buying, a new buyer, maybe first-time home buyer, or maybe moving up or downsizing, what tips do you have for them now?
Yeah, and we were talking about earlier about people who apply if they need extra work done or what that usually looks like. Each scenario is unique, right? Everything is unique to that specific person. But I'd say if you were planning on buying something in 2026, the earlier the better. It makes sense to start the pre-approval process. Talk to a realtor, talk to Paige and her team, because then that gives you the opportunity to set things up to put you in the best situation to find something that works. I mean, we've seen it all the time where someone's like, hey, I found this house right now that I want to buy. And it's like, all right, well, does it fit inside your budget? You're able to make it work. The earlier you talk to a lender, earlier you talk to a realtor, you can establish things like your budget. Let's say your credit needs a little bit of work, and there's opportunities for us to raise your scores. Maybe it takes a
Yeah.
little bit of time, or we know, hey, there's certain down payment assistance programs going to be available at this certain time point. So having those conversations sooner, I'd say now, if you're interested in the next couple months,
Yeah.
makes sense to set yourself up in the long run for success.
Well, and that's a really what you said a couple minutes ago about often people find the house and then they call you or whatever, and here's the house I want. I do think it's somehow easier for people to kind of go online and look at all the houses and how fun and everything, which I totally get. But
yeah,
to your point, if you're considering buying or making a change, probably best to get in touch with a lender as your first step.
yeah,
For sure.
and
I know it's time already. It just
Yeah.
flies by. It's unreal. So thank you again for being here and for being one of our sponsors. And Matt Berna, True Stone Home Mortgage. You can find him online. I'm Paige with the Real Estate Collaborative, and you can find us at therecolab.com. And we will be back next Sunday. Have a good week, everyone.